Okay. So y'all should have your chapter 12 stuff kind of filled out. Yep. Yep. Oh, and here, yes, he's going to start now. Did you pass your quiz? You did? I'm impressed. Okay. Your reading quiz. You passed your reading quiz?
Yes, I got one. I had to take it twice. But.
That's all right. Well, you know what? Even if he didn't read the stuff, taking the quiz forced him to get familiar with stuff, right? So it's a dual purpose assignment. So hey, if you need to copy the answers down, go ahead, write fast. Y'all gonna be bored, huh? You are did y'all because y'all are good little girls. You need a packet. Okay. Sit right there and dig on the part of okay, I combine reading and worksheets. I'm trying to try to do that every chapter, so it's impossible. Just let me do that.
Is individual and calendar the same thing?
Is individual and what?
Calendar.
Yeah. Yeah. It's a single owner, but would be one single individual. You got to do the same thing. All right, so the four most common types of business entities, proprietorship. That's what we did all first accounting for. One was proprietorships. That's the only thing we really looked at. This semester we'll look at corporations, partnerships, limited liability companies. You'll also hear me call them LLCs. So this one, that's next chapter. So we won't really get too in depth about it. There's some basics you'll learn in this chapter, but so are you through? If I roll up too high, you'll
No.
Proprietorship, that's one owner. That's what we did last semester. So we had like Chris Clark Capital or whatever, and that was it. Only capital count. So you'll see a lot of professional service providers formed as proprietorships, like lawyers, architects, realtors, doctors, which is kind of scary, but because your liability is, you're exposed. All right, so proprietorships are easy to form. You don't have to fill out a bunch of paperwork. So they're easy to do. But the problem is there's no limitation on your exposure. So if your business gets sued and maybe you don't have enough insurance to pay the claim or to pay the whatever, the award or whatever, then your personal assets are up for grabs. So that's kind of scary. So if you have an investment account or money or a house with some equity, all that's up for grabs, and they can take it to pay the award. So it's kind of scary. You're exposed personally. And any money that's owed, if the business goes under, then you personally may be responsible for paying those bills if you have anything to pay them with. They're not taxable in and of themselves. The net income you as an individual owner pay tax on. So it kind of flows through. That's what it's called. Pass through. Pass through, flow through, same thing. You know, it has a limited life. When the owner dies, there's no more business because it's a single owner. They retire, the business is gone. They don't have a lot of resources for raising money to like expand the business or if they need money for equipment or something. The owner is the only source. So whatever the owner has or whatever the owner can borrow, they're pretty much limited to. All right. So the next one is a partnership. That's the same thing, except you got two or more people in it now. If you see the words general partnership in any of your questions, multiple choice questions and so on, that's just a basic form of a partnership. It means the same thing. So you're not going to see this one used quite as much as a proprietorship, and there's reasons why. So you have to do some paperwork with this one. It's a little bit more complex to form. Y'all pass moderately complex. All right, you have to have a partnership agreement, and if you don't, you're not really knowing what you're getting into. So if you go into business with somebody ever, I just don't know. It's really scary. Because you can say you really need to know the person well that you're going into business with. But no, I've been watching a lot of those crime movies where they say you really don't know anybody. And it's like, oh, yeah, that's true. That stuff's scary. People flip and do all kinds of crazy stuff. But if you're going to go into partnership with somebody, make sure you have a partnership agreement. So that'll tell you how much is going to be invested by each person, limits on how much they can take out. Because I have known people in business together, and one of the partners, he was really he was doing things he shouldn't have been doing, taking out way too much money. I don't know if they had an agreement or not. How are we going to distribute the income? Are we going to admit other partners one day, or what if somebody wants out? So use an attorney. If you ever decide to like organize a business or something, a lot of accountants will tell you, I can do that for you. And they can, but we're told as accountants that we're not lawyers, which I wouldn't do it because I'm not a lawyer. That's something a lawyer's supposed to do. So at the very least, have an attorney look over it before you file it, and it becomes, permanent. All right, so same thing with partnerships. There's no limitation on that legal liability. So if something happens, you are liable for it, and all the other partners are too, whether they had anything to do with it or not. It's not taxable. The net income is taxed, but it's taxed on each partner's return based on how much their share is. There is a limited life. When a partner dies or retires, the partnership stops unless you've got something in the agreement that allows for admission and withdrawals. So, I mean, and it kind of makes sense. If you have a partnership of, these 5 people right here, maybe Pablo wants to get out. Well, that original partnership is not the same, and it's changed, so it's over. And if it's just y'all forced it, then it's a new partnership. So it's just technicalities. But all right, again, coming up with some money if they need to do something is limited to what the partners can borrow or what they have to put into the business. Unique characteristics of partnerships, which I really see these as disadvantages. Co-ownership of partnership property. So if you put something into the business, let's say you're going to put in some equipment or something like that, because maybe you had a construction business and you're going to put in some construction equipment. Well, once you put it into the partnership, now it belongs to all partners. It belongs to the partnership. So just keep that in mind. So if it gets torn up, it's not yours anymore, it's everybody's. So make a star by this next thing. When a partnership ends, each partner's share of the partnership assets is the balance in his or her capital account. So what that means is partnership is over with, they're ending the business, they're going to sell everything, pay everything off, they got cash. How much cash is each partner going to get? They're going to get whatever they got in their capital account. That's it. So that'll come up at the end of the chapter. But you'll have to know that. Mutual agency, I don't like this one either. Y'all know what an agent is, right? Somebody that represents you and can act on your behalf. Like maybe it's a sports agent or a talent agent or whatever. Well, in a partnership, each partner is an agent. So they can get into contracts and agreements on behalf of the partnership. So if you have an idiot for a partner, you might get into all kinds of things that you don't want to be involved in. And any debts that they create in the name of the partnership becomes your debt too. So it's kind of scary. The way that we allocate net income for partners, it should be outlined in the partnership agreement. They should say in the agreement, partner A gets this much, B gets this much, and so on. If it's not specifically stated, then the default is that it is divided equally. Where are y'all? So you could have taken a nap.
No, I was gonna say in this room. That's where I'm at right now.
Do where you at? Yeah, don't end your sentence with it. Sometimes on these recordings, I'll hear things I'm saying. I'm like, oh gosh, that's the worst English I've ever heard in my life. I know better than that. That's how I speak. That's kind of scary. You don't realize it sometimes until you listen to yourself, and it's like, oh my gosh, did I really say that?
You never realize how weird you sound either until you hear it on video.
Well, I say okay a lot. Okay. Oh, you gotta stop that too. It almost takes too much concentration, and I'm trying to like talk about how to do something. So.
I used to use the word like as much as I
Oh, I do too. I use that one too. All right. An LLC. An LLC, that stands for Limited Liability Company. You treat it the same as a partnership for accounting and for taxes, but the difference is that the owners are protected from liability. So if something happens, the furthest, a claimant can go is the assets of the business. You're protected. Your personal stuff's protected. So it's almost like a no-brainer. Even if you're just a sole proprietor or partners, why wouldn't you form an LLC? You get that liability protection where, somebody making a claim, they can't take your stuff. Okay. So the LLC, because of that, is popular. It's still moderately complex to form. You got to have an operating agreement. And instead of partners, the owners are called members. All right, so same elements in the operating agreement that were in the partnership agreement. Use an attorney. In this case, you're going to have limited legal liability. So, the owner's personal assets are legally protected. The only thing you're going to lose in an LLC if you get sued or something happens is what you put in, your investment. So again, it's kind of a no-brainer. All right. For taxes, an LLC can make an election with the IRS to be treated like a partnership and file a partnership tax return. But the net effect's still the same. Each partner or member is going to get their allocated share. Okay. An LLC has unlimited life, where a partnership is limited to, the partners staying in, or it being dealt with in the agreement. But most LLC agreements specify that the business won't die or discontinue if somebody dies, passes away, retires, withdraws, whatever. They have a little bit better ability to raise money. You're going to have an easier time talking investors into putting money into your business if you've got that liability protection, and they know that that's an element there. All right, so accounting for LLC, same as accounting for partnership, except for the owners are called members. You have members' equity, and in partnership, it's partner and partner's capital. It's just terminology as far as the accounting for it. All right. So when a partnership's formed, when you have nothing, you have two or more people get together, they're going to form a partnership. When you're making the entries for the books, you're going to do a separate entry for each partner's contribution. So anything they put in is going to go to the appropriate asset account. Something different about this, though. We were in accounting 1, everything was put in at cost, whatever was spent for it and that sort of thing. When a partnership is formed, you've got individuals coming in with assets that they're bringing in. You're looking at the value of it, not the cost. Now, partner A and partner B may have their own individual sets of books. Maybe they have, y'all remember what book value is? How you get book value? How do you get book value?
Like market development.
So what it caused,
Cost minus something.
the depreciation through that?
Mm-hmm.
Accumulated depreciation is equal to what?
All right, so cost minus accumulated depreciation is book value. So if you see book value on one of these problems, that's what it comes from. But we're not, when you're forming a new partnership, it's not that doesn't matter. That matters on the old set of books. But when you're putting stuff, okay, let's look at it like this. Let's say you've got your own business you've had for a while and you decided to go into business with a friend or something like that. And let's say you had some equipment that maybe the book value of it's $7,000, but if you like tried to sell it or something, you could get 10. Well, when you're putting your assets into this new partnership, if that piece of equipment is worth 10, don't you want $10,000 worth of equity? I mean, it just makes sense because your books are still going to stay intact. You're going to have to do whatever to close it out, but the book value is specific to this original entity. You don't have to worry about carrying that book value to this new set of books. You're bringing this piece of equipment. What's it worth? Does that make sense? Just remember to use current value. Current value, market value, same thing. Now, if the partners sit down and they look at, you know, an asset or inventory or whatever, and they agree on an amount, then you're going to want to use that because they're probably agreeing on, if they both agree, then, you know, it's fair. That's the value you're going to use because a lot of times you have obsolete inventory and stuff like that. Okay. So if they assume liabilities, it goes to the liability account, difference goes to capital. All right, so here's our first example. I know y'all haven't seen allowance for doubtful accounts. That's a chapter we didn't get to. But it's kind of like accumulated depreciation. It's a contra account for accounts receivable. And it's one of those that would be an estimate, like at the end of the year, we estimated how many returns, you know, of merchandise we would get. They hadn't been returned yet, but we're going to estimate based on history how much is typically returned. So that's kind of what that is. So it's showing there is just a number, but it's a contra asset. So what kind of balance is it going to have? Credit. Okay. So in this problem, they just are giving us amounts. We're going to assume that they're current values because they don't tell us anything different. They're not giving us book values. It's just straight up, here's the numbers. This is what she's putting in. So the entry is just simple. You're just putting all this stuff on there. And it's April 1. So this is the easiest version of this. It says merchandise inventory. Sorry. I can change that. I don't know that it really matters. Here inside. Store equipment, office equipment. So we got 7,200, 16,3, 28,7, 54, and 2,500. All right, can y'all read my handwriting? I mean, it's just at the top, so it should be pretty easy. All right, so then you'll put allowance for doubtful accounts. If you want to abbreviate, that's fine. As long as I know what you're saying. 1,500. They've got accounts payable that they're bringing over. She's bringing over all her cash. So, I mean, if she wasn't combining, or he, sorry, if he wasn't combining the businesses, he would have paid these payables with the cash he had. So that's not unusual for them to bring in. All right. So what's the difference? What does the difference go to? Who's Who's contributing these assets?
Joseph Stevens. So capital for Joseph Stevens.
So go to Stevens Capital, or Joseph Stevens Capital, whatever. And how much is that?
56,000.
56,000. He's gonna, all right, so right below that, I gave you a, reminder, assets are debited, use market value if it's available, liabilities are credited, the difference goes to capital of the partner and stuff. Questions? That one's pretty easy. She listened to me. I don't think she did. I love cold weather. I love it. But this is what I hate. Because you can't escape it. And it's like the smothering heater comes on and you can't get away from it. You can't open the windows. It should be a fire hazard or something, shouldn't it? I don't know. If we had a fire, I'll throw something through the window. I'll stand back and let one of y'all throw something through the window. They did it. All right, so this one is a little, adds a little bit to it. You got Reese Howell contributing equipment, inventory, and cash. All right, so the equipment had a book value of 23 and a market value of 29. Inventory book value of 60, but only had a market value of 15,000 due to obsolescence. Y'all know what that means?
Goes out of stock or
It wasn't any good anymore. You can't sell it.
it's not useful anymore.
Yeah, right. Partnership also assumed a $12,000 note payable owed by Howell that was originally used to purchase the equipment. So there again, if this was you going into business with this person, would you want to allow them $60,000 in credit for worthless inventory? Because eventually you're going to have to write the crap off. It's not any good. And you, as their partner, will have to eat part of that loss that had nothing to do with you. So, you want to be careful with these, with what you agree to. All right, so December 31. All right, so we got cash. That's easy. And then equipment, you're going to look at the market value. And inventory, we're going to take market value. And then we have to pick up this note. Okay, so just make sure you address everything that they give you. Cash, equipment, inventory. Yeah, I was trying to think of something. Technology is what I was thinking is probably obsolete. Or it may be, could be lots of things, I guess. Could be food that's not good anymore. Could be clothes from like 3 decades ago that nobody, I don't know, that stuff's coming back in style. That's a bad example.
So again, you always use market value.
Yeah. Or if you have the situation, they're not going to tell you the current value is this, and then they agreed upon this. If you see agreed on, just take that as the same as current value. All right, so the difference will go to Howell Capital. All right, so 12,000 is the note. So how much is the difference? So you're just taking the assets, subtract the liability, and the difference is going to be her contribution.
66,000.
Okay, y'all look at example 3 and see if it makes sense to you. Work that one real quick. Shouldn't take you 2 seconds. Maybe.
There's no basis. So,
Y'all bring your calculator. Because if you use your phone as a calculator, I'm not going to be playing your phone. I'm going to call you for the answers. You have worksheets? Okay. I've got plenty of extras. If you want to grab another pack, you can fill in the pages that you're missing. But take the whole, I got too many copies. I messed up. Or they messed up, I'm not sure which. It's probably their insult. But then we did have people that had a tendency to reduce their packets. So yeah, just get what you want out of that. And you can substitute. All right. So on this one, Jerry Hunter's putting in land, inventory, and cash. So the land, the book value. I hate those kind of pencils. Do they not bother you? Do you have to have your point like sharp all the time? That's why I don't like them, because I like a sharp point on it. I'm constantly having to sharpen it.
It's been like a decade since I've used pencils.
I have, I just don't like them. All right, so what are we doing on this entry? We don't have a date, so don't worry about that. What's the first thing we're gonna put on here?
Okay.
Sean.
Cash.
Do you want it in order of liquidity or no?
Huh?
Does it matter?
No, it doesn't matter. It's just an entry. Just do your debits first, so when you get to Cengage, it'll be agreeable to you.
Inventory.
How much?
She did not give us a date.
No, it did not. How much do we put on here for inventory?
47,000.
Everybody understand the 47,000?
So you said 30,000.
Market value. Yes.
Market value.
What's next? How much?
260,000.
Does the order matter there?
No, just do your debits first, just for Cengage. Because you may put it all in there, it may all be right, but you know it may not give you credit for the whole thing.
But you should put inventory first, then land.
That's specifically for.
That's the
financial.
order it's gonna show up on the balance sheet. I
Yeah.
mean, if it's easier for you to remember to put them in that order, that's fine.
I was gonna
It's
say
not
that's-
wrong if you do
It's
something
literally
different.
exactly just for the balance sheet, but it's easier to remember.
You know what you're doing, you can do it. Pressure?
Right. Sure.
Just like a love-hate sort of thing, I mean, or do y'all just really not like
We
each
can
other?
have it.
I'm gonna be helping Pablo with his homework.
Don't make me talk.
I'm sorry, did I laugh out loud?
Don't make me talk.
Okay.
You know, we're gonna.
It's not that you're not smart, because I know you can do it, it's that you won't do it, that's the problem. I'm not laughing at you as if you can't, I know you can. I do.
You're like, you can work ahead, so.
You can do it.
You can.
Yeah, I mean, there's not anybody in here that can't do it. Some of us are just more, I don't know, anal about it than others. All right, so how much for note payable?
68,000.
No, yeah, I'm on the wrong one, sorry.
What? I was like, what?
I'm sorry. All right, so now what's the difference?
279.
Okay.
And Hunter.
You know, I get it. Not everybody likes school. And if you're an athlete, sometimes you're here just to play ball. I get it. All right, so this next part will save you from having to read, so just humor me.
I already read through 12.2.
You did? Well, good for you. Well, you can check your answers. Y'all good here? All right, so part 2. I hadn't had y'all to read this yet, so you won't have any answers.
Oh, that's a good place.
That's good. Oh, yeah, you did get ahead. All right, so we had already talked about the fact that income and losses in a partnership should be specified in the partnership agreement how it's going to be divided. And when I'm talking about this, what I mean is, do y'all remember how to do a closing entry?
Like close out accounts, yeah.
Like you got the 2 closing entries, you close out revenue and expense, and then you close out drawing.
Yep.
So you debit revenues, credit expenses, and then either debit or credit capital. Well, that's when you have one owner. You have 2 owners. How are you gonna split that up? That's what we're talking about. They should dictate in the partnership agreement how they're gonna split that up. If they don't, then it's split equally.
So maybe we have to do the same twice.
If you have two partners, it'll be 50-50. If you got three, you know, you're just gonna, they're
So
each gonna
we
get the
gotta
same.
we gotta do 2 closing entries.
You do one closing entry, but you'll have multiple capital accounts.
Yeah, you'll debit or credit them based on.
And then you're going through this right here because you're trying to determine how much goes to each capital account. Does that make sense?
So either it's equal or they.
It's equal or it's allocated based on something they agreed on. All right. So there's a couple of ways that they'll allocate, that they determine who gets what. One way is services of the partners. So if you're going into partnership with somebody and, I don't know, I always pick on the athletes. Y'all ever give, like lessons for pitching or hitting or anything? Y'all do that on the side for kids?
I do that.
You do? Okay, so let's say you go into partnership with, I don't know.
No, we
Sean.
don't. No, we don't.
I wouldn't want to handle you either.
I know, that's what I'm saying.
You guys like an athlete and a manager, right? That's a partnership, an athlete and a manager.
Could be, yeah. But let's say that Harley and Pablo go into business. 'Cause Harley's like a numbers guy, and Pablo's got skills to, you know, train kids. So you're not gonna spend a whole lot of time there because you're gonna come in, you know, do the books, that kind of stuff. He's the one that is gonna spend the majority of the time there. So that's what that means with services provided. So if he, of all the time put in, if he's 75% and you're 25%, you'll consider that when you're determining who gets what income. Okay. So you're gonna see on these problems salary allowances. Partners don't get salaries. They're just like owners. They take withdrawals. The salary allowance is just a figure of speech. It's kind of like, if I were to pay you a salary for what you're doing, what would it be worth? It's just a method of allocating. Okay, it's a method of determining how much net income goes to each person. Okay, it's not a literal paycheck because partners don't get paychecks. Employees do, but partners take withdrawals. We are strictly using thought process to say, okay, he's going to get this much, you're going to get that much of the net income. So when we close books, this is what goes to your capital, this is what goes to his capital. Okay. So partners are not employees. Allocated income is credited to partners' capital accounts. There's still two closing entries, like always. The first one, you're going to debit revenues, credit expenses, and then the partners' capital accounts will be either credited or debited based on net income or net loss, and the allocation would come up with. So the second entry is going to close the drawing accounts. So that's not any different, except you'll have multiple capital accounts. So there's another way to do it using the services, you know, ratio like we just talked about, and then there's another one called investments. Well, they will agree on a certain interest rate times their capital balance, because let's say you're putting in more time, but Harley put in some cash. So it's not fair if you get 75% of the net income, but he put this money in. So you have both ways of doing it to even it out. So if you do an interest, and he's not literally getting an interest check, it's like an allowance towards that allocation. So if we use that as well, then that trues it up and makes it more fair. So if you use, be nice, use 12% times the capital amount on this first problem we're going to do. Sorry, 12% comes from, it's a problem we're doing. So let's say 12% is the interest rate we're going to pay on partners' investments as of a certain date. Then that is just another allocation. Okay, so we're going to have a problem where we end up with more allocated than we have in net income, and I'll show you what to do with that. All right, so this is just kind of a recap. It tells you the same things I was saying a minute ago. If you get confused about it, go back and read that. All right, so we're going to have several examples, and we're going to use the same information Examples 1, 2, 3, we're just gonna add to each one. So the first, it's the same two people, their salary allowance is gonna be the same. So in this one, we've got Jennifer Stone and Crystal Mills. All right, so what you need to know, and I don't think your problems are gonna be like this most of the time. Most of the time, they should give you annual salary. That's what you want, is annual. That's monthly. You need to use the whole year in this allocation, so we're gonna have to figure out what the years. But most of your homework problems I've noticed is annual. So, all right, if we were trying to figure out what her annual salary is, multiply it by 12. And this is not, like I said, it's not a literal salary. It's like if you were getting paid a salary, what would your time be worth? So that's putting a value on the time they're spending in the business. Does that make sense? It gets kind of confusing when you start getting in all these problems. You're like, oh, what's a salary thing? All right, so we're just going to fill in. When you have homework, you may or may not have these charts. I don't think you have these charts on there. They're just going to ask you how much net income is allocated to such and such partner. Well, just set it up like this and fill in your blanks. I'm showing you this method of doing it with this chart, these blanks. You're just going to have to, piece of paper, set it up the same way. Because the question that they'll give you all this information and then they'll say, how much income was allocated to meals? So what your answer will be is whatever's there. All right, so they've got their salary amounts. Anything left over is divided equally, and here is our net income. All right, so Stone's salary is 72. Mills is 60. So I'm just filling in the blanks and then total it across. All right, so the only thing they have in their partnership agreement for allocation purposes that's specific is her salary allowance will be this much, hers will be this much. So this is something that like they're estimating when they form the partnership. We think we'll have this much in net income, blah, blah, blah. So it's really gonna come out perfect. And maybe some years they'll have less than they think they're gonna have. So they're just projecting. So they've come up with, they've allocated 132,000 of income. How much is net income?
160.
It's 160. So they still, you should come out with net income here every time. It should add down, it should add across. So that's one thing that kind of gets everybody, is calculating that remaining income. Just go backwards. You've got to come out with 160 at the bottom. So what would it take?
Okay.
All right, so that's your remaining income. Remaining income is the same thing as unallocated income. Or loss. Depends on the problem. Okay, so how much is each one of them will get?
14,000.
So each one of them will get 14,000. All right, so now you just add it down. That's all we've got to allocate. So Mills gets 74. Stone gets 86. Now, to make sure that you got the right answers, this should add across. This should add down. So you should come to 160. We call it foot and cross foot. That's foot, cross foot. County audit nerve term. What?
Sounds a lot like CrossFit.
It does. Foot, cross foot. All right, so I put that on here. It should, the total column should equal the net income, sorry. So there is your formula to come up with remaining income in a problem with just salary allowance. All right, so we talked about the interest on capital. Makes it more fair if you've got one partner that's putting time in and another partner's putting money in. You don't want to just use one method. So this is an example where they use salary and interest allocation methods. So you got the same information for the salary part. So you're paying Stone 6, Mills 5 per month. So we've already figured this, 72. This is from the previous problem. We already calculated this part. This line's the same. All right, so if we are allowing 12% interest on each partner's capital balance as of January 1. How do we figure that? Jeopardy music. Take 12% of the capital amount. That's their interest allowance. So how much is 12% of the 180? It's 21.6. You do not want to calculate 12% of their salary. That's not right. I see that a lot. That's a common mistake. We are calculating 12% on the partner's capital accounts balances that they're giving you right there. So don't use that rate times salary. All right, 150 times 12% is 18. All right, so here's our second level of allocation. So Mills is 18,000 and Stone is 21.6. Well, since we had two parts to this and we've got to calculate remaining income, I put a total there just to try to make it easier. All right, so 21.6 and 18,000 total is how much?
9,300.
Transposing number.
Oh,
39.
I thought we were doing the,
Which one? This one?
yes, the ones.
Well, you're right. It's backwards. That's funny. I didn't notice that before. Yeah, you got to add them all up. So, yeah, you're right. So, how much is the total that we've allocated so far? It'd be 93.6 plus 78.
171,600.
Okay, so this is the amount that we have currently allocated. And remember, oh, come on. So irritating. All right, remaining income is going to be equal. Net income is 180. So, I mean, you can go ahead and put 180 here to figure out how much your remaining income is. Or, I mean,
8,400.
Huh?
8,400.
Yep, it's 8,400. All right, so if we're dividing it equally, you're going to give each one of them 4,200. And then add it down. Okay, so if your homework question says you've got this information, that information just listed like that, make sure that it adds this way and down. You're not going to have this chart, like I said. They're going to say with these items of information, how much is, they're going to give you a list of stuff. How much was Crystal Mills, how much was allocated to her? How much was her net income? It'd be 82.2. That make sense? And if y'all get to doing these and you're like, I have no idea what it's asking me because it doesn't sound the same as what we did in class, I'm trying to remember how they're worded so that you are looking for that. All right, so there's your remaining income formula when you have the two elements that you're using to allocate. Okay, so let's look at one where we have a lesser amount of net income than our allocation amount. So we've already calculated this. This is the same number, 72,000, 60,000. This came from the previous problems. All right, this interest we can get from the last problem, 21.6, 18, for a total of 39.6. Am I leaving anybody? Y'all know where all this is coming from? All right, and then the totals are 93.6 and 78. So our total here, we have allocated 171,600. But our net income's 110. Well, there again, I mean, when they made the partnership agreement, they came up with this method of doing it based on what they think their net income is going to be every year. Well, maybe they had a bad year. So, I mean, they still have to use the same allocation, but their net income is lower than they anticipated. So you take the net income of 110 and subtract out what you've already allocated to come up with your remaining income or loss. That's not technically a loss, but you've over allocated at this point, so you've got to even it back up. So what's our difference here?
6.1, 600,
Yeah, if you take 110,000 and subtract,
negative 61,600.
yeah, negative 61,600. All right, so, and that's the thing. I mean, you could do the same way we did before. We've got to get to 110 and we've got 171.6. So we've got to subtract this out for the equation to work. That makes sense? So it's split equally. So each one gets 30,800. So Stone's net income is 62.8. And Mills is 47.2. And again, just make sure your math works. If it doesn't work, you've done something wrong somewhere. A lot of times it's the remaining income that confuses everybody. It's like, how do we get that account number? All right, so that's where I stopped with the other class. So yes, you get to go early.
Thank you.
Just depending on how fast we got through it. Unless you have questions, you can stay. You want me to keep this back? You can, yeah. Or if you want to bring the extra pages up here, somebody else may. It doesn't matter.
Dave, you know what he texted me?
Are you talking to me?
Yes.